Hi everyone, and welcome to today's session on the indices. And we are actually going to look at a couple of commodities as well, which have been very interesting from a VPA perspective and support and resistance. One of them is gold and probably oil as well. But before we start, can I just draw your attention to the disclaimer that I know you can see on your screen? Please, I implore you, do not ever think of entering this market with money that you cannot afford to lose. So we said that. I know you've seen it. It has been said many times before, but we really do have to reiterate it every time we start one of these sessions. If this is your first time, welcome. If this is your second or third or however many times you've been with us before, you're all welcome. As you know, I run this session together with my husband David. He's sitting opposite me at the moment, not at right angle, so I can only peer at him through a couple of my screens. What we do in these sessions, we've renamed this session. We used to do a bit of stocks and a bit of this and a bit of this, but we're primarily going to be focusing on day trading. And day trading, primarily the indices. As I said, we've got a couple of commodity contracts that we're going to have a look at well. But the methodology that we use for these markets, and in fact it's the methodology that we use for all the markets, whether that's trading or investing, is volume price analysis. And I know we always have people coming along to this session who've actually very kindly bought the book that you can see up on Amazon, and it's still doing very well, and I'm still getting fantastic reviews and lots of lovely emails from people just saying how much they've appreciated and how much it has genuinely transformed both their trading and investing. So the methodology is VPA. We'll see it in action on the charts that we're going to have a look at. But of course, that's just the technical analysis side of trading. We also have to be aware of what is going on from a fundamental perspective and increasingly a political perspective. And the highlight today, as we can see on Forex Factory, is in fact Fed Chair Powell is going to be at an event, I think he's in Washington. What does it say here on Forex Factory? Yeah, the Economic Club of Washington. What's interesting about this is, I mean, it's always very important to listen whenever the chairman of the Federal Reserve is speaking, and that is on this event. He is actually going to be taking audience questions. Now, obviously, you're all aware of the background to the markets, where we had a terrible December from the perspective of an investment. And I just have to step back and just clarify. When you read the news or you hear the news and you say, oh, you see all those wonderful photographs of and shots of traders, you know, hanging the heads in their hands, saying, oh, isn't it awful, the Dow's fallen this, the Dow's fallen that. Well, that is bad if you are investing and perhaps you put your money in at the top of the market from a fear of missing out, which is why most people buy at the top. It's purely a fear of missing out, which has deliberately been engineered by the market makers. But we have to remember, from a trading perspective, volatility, markets falling, markets rising are tremendous opportunities, because when they don't move don't give us enough of a range, and I think at the moment they are, because of Powell and obviously what's gone before, we've had all the fireworks and the volatility. It can be very frustrating, and the days that we have been blessed with in the last sort of week or so, they are pretty rare. They're not the norm. The norm is much more ploddy, quiet, consolidation, congestion, and that's really, if you trade through those conditions and you know how to trade through those conditions using VPA, using support and resistance levels, that's when you will, you've really made it as a trader. Because trading actually should be quite boring. It should just be, yeah, I'm in front of my screen, I'm going to take a trade, fine. Yeah, it shouldn't be full of fireworks. The fireworks are great, but boy, if you're on the wrong side of the market, they will kill you. Right, David, would you like to say something before we move to the charts?
Apologies, I was just
chatting.
No, I wasn't chatting. I was moving my charts around. Apologies. Good to see you all here today. Very warm welcome, and just sort of checking across the markets. The indices are all flip-flopping around in consolidation. No great surprise given we've got quite a raft of Fed speak later on happening today. So I don't know what we're going to find on the indices. They're all trading in pretty thin ranges. But we'll have a look at gold, have a look at oil, as Anna said. If you've got any questions, please just drop them in the chat box. Happy to answer them there. Or if they are longer questions, we can answer them on air for you. I'm going to pass back to Anna, and we'll get going.
Before we move over to David's charts, because he has all the indices. As I said, I just have the gold and the oil up, because with gold in particular, I've been writing and trading in gold for many years. But in particular, I've been writing about, when was that 1300 came in? We were very bullish, very positive on gold, middle of December. And so it had a really nice move up. We'll have a look at it anyway, but it's hit it can't seem to get through the 1300 dollar per ounce level. But I'm just going over to investing.com just to see what the futures are up to, and we can see here they're actually slightly ticking up. What's interesting with the VIX is still at 20, which is not hugely high, but neither is it, if we want complacency to come back into this market, and we want risk on to come back into this market, consistent risk on appetite, then we really want to see that move back. I wouldn't say back into single figures, but certainly back into the 10s and 11s. But having, looking at something like investing.com, it gives you an immediate flavor of what is going on in the markets. And I've actually got the bond yields up here. What's interesting, the 10-year gone back below 3. If you remember, 3% was the was this magic number. It crept over 3, and it was it's now below, but it's differential between the short term and the long term. They're very close, so we have a sort of flattening yield curve, which is really not what you want to see in terms of things continuing to move ever higher. If you have this inversion, it's if it happens, it's not good news. Right, let me just go to my charts very quickly. Here we are. Right. Oh, it's disappeared. Where is it? Go away. I just wanted to have a look at gold. Let's have a look. Let's pull this up here. Let's have a look. This is the 30-minute chart. Let's have a look at the weekly. There we are. This is the price action that we've been seeing. As I said here, we had this big fall back in the middle of August. In fact, that level held. I think it was 1167, 1170, which was a very important level. It did hold. We had buying coming in, and I think we said at the time, moved into consolidation, which you would expect after such a very dramatic waterfall that we see here. And this, as I said, this is the weekly chart moving sideways. And it's kind of really been edging up. Had a bit sort of a few hiccups along the way, but generally it has been supported. But this is the key level here. This is the 1300 level, which it just cannot seem to get through. It's had one run up, it's had another run up. And if you are a gold investor or you want to be long gold, then this is the level that it needs to clear. And when we talk about levels, if you're a trader, of course, it's a different ball game. You may trade it to the long side, you may trade it to the short side. It really all depends on what the chart is telling you, and you'll be looking at the shorter, the faster time frames. And this is gold, as I've got here on a much plainer chart. I've just got some candles, I've got the volume on here, and I've got my levels for gold, significant levels on this chart derived from our Camarilla indicator. And this indicator we have developed for both MT45 and for NinjaTrader. And in fact, if I just scrunch that down, you'll see we've actually got 6 levels. Most, when Camarilla is used, it tends to be used just with 4 resistance and 4 support, but for various reasons we looked into it, we decided that no, 4 wasn't quite enough, so we'd go for 6. And the nice thing with this particular chart, the 60-minute, is these calculations, these levels on this chart will stay on this chart until the end of this week. It's the way we've developed the indicator. But if you go down to the faster charts, if you go down to, say, if we go down to the 5-minute chart here we are. You'll see here you have very different values, and these values are calculated on a daily basis. So every time the market closes and then reopens, the values are recalculated when you pop them back on your chart. And the reason for having there's different values on the different time frames is because if you are going to be you want to trade this this particular instrument on the faster time frames, and by the way, this applies to anything, not just gold. It's just gold happens to be quite interesting at the moment. What you can do is you can, so if you wanted to take a trade to the long side, for example, on the faster time frames, well, by going up to the 60-minute chart, what it tells you is that it's obviously had this this inability to move beyond the as I said, it's about 13. It's the 1300. It's actually 1297, 1298. And the important thing about the R4 in terms of the Camarilla protocol, if you just have 4 levels, is that for any instrument to continue higher, it must break this level, and it's often said that if it breaks the R4 with good, in our opinion, with good volume, it is considered potentially a valid breakout. What happens with the R4 level, and similarly down with the S4 level, is that often it will test that level on numerous occasions, and obviously every time a level is tested, it then becomes strong, it gets stronger and stronger. So every time it retests, it's going to have to make even more of an effort to get through. And then when it does go through, it very often can come back and retest. But if it manages to get through the 1300, because it's been tested so many times going the way up, that level becomes a very strong support level, a support line. And it's really understanding where those levels are and the significance of those levels. If you are thinking of either putting on a trade, perhaps adding to a position, or even if you've been in a trade and you are thinking of exiting. So the R4 and the S4 are really, really important levels. And the reason we put the additional levels is because when you get to R5, it gives us our targets. It gives us a potential target, not a target in terms of risk and reward, but a price objective that this instrument, if it's going to go, and all things being equal, that is where it is then likely to pause next in its travel. And then we also have the R6, and the same applies when it gets there. It tends to sort of maybe test it once, maybe test it twice, etc., etc. But it gives your levels a degree of hierarchy, as it were. But going back down to the faster time frames as a scalper or as a faster time frame trader, what is actually happening is the price is actually between what we call the R1 and S1, and that is what is like a buffer or a neutral zone, which basically means it's in congestion. So it's back to congestion again. And what do we do when an instrument is in congestion? A lot of traders don't like congestion phases. They find them, they are very frustrating. But again, you have the levels to tell you, to help you, that at least when it gets to one of these points, either the R1 and the S1, what is going to happen? Well, the R1 we know down here. On this time frame, it's at just over 1293. If it gets through, you've got your price objectives here and here. And with gold, of course, we need to see what is happening on the dollar index. And I have an index down here myself. Let's have a look. This is on the 30-minute. Let's move it down to the faster time frame. Let's move down to 10 minutes, see what's happening. And again, it's, even the dollar, it's had a run up. Generally, when the dollar rises, gold commodities will tend to fall. When a weaker dollar is always good for commodities. But with gold and the dollar, the relationship it's been sort of falling in and out of correlation, which it does do on occasion. So that's where we are with gold. And on the faster time frame, we've got the Renko here. It's a non-time-based chart, because one of the ways you can take advantage of congestion phases is to use a non-time-based chart. I've got the Renko using the Renko optimizer, and the chart tells its own story. What sort of phase of price action is this particular instrument in? Well, there's a lot of up and down, and there is no clear direction. Even though the longer term, in terms of the week, it is still bullish, but only once it, the bullish momentum will continue if it manages to get through $1,300 per ounce. David, is there anything you want to say to that?
Thanks, darling. Sorry, I've just been monitoring the indices because there is actually a half decent move going on. I've got the ES up, but we can transfer over. Do you want to switch over? Sure. Just got a couple of comments on oil as well. Do you want me to bring it up, or have you got it? I've got it over here. Yeah. Just going to switch screens. Bear with us a moment. Just switching over. Should be coming up any minute. There we go. I've gone straight to the tick chart workspace on this occasion rather than focus on the time. Just pull this down a bit. There we go. There we go. Okay. I don't know why. Wait, just bear with me one moment. What's the matter? The charts are updating, but this isn't. How weird is that? Okay, it's all right. I'll fix that. Yeah. This one isn't. The 1 minute. How weird. Okay. For some reason, the 1 minute's not updating, but never mind. We'll move on. I've gone to the tick charts because what it reveals is, and we're on the ES here. And basically, I've got a Renko bottom left, and then I've got the 3 tick charts. My preferred is to use 3. You may use 4. You may use 2. I always like to use 3, both on time and tick and non-time based charts. And then down the side here, I have the tick speedometer on 3 different time frames. I've got it on the 1 minute, I've got it on the 3 minute, and I've got it on the 5 minute at the bottom. But again, you could have 1, 2, 3. You could even go down to the seconds if you're trading at a super fast speed. And the reason that I wanted to start with the tick charts is for several reasons. First of all, trading on a tick chart reveals momentum. It's like the Renko. You're taking time out of the equation. So when a candle forms, it is formed on a completely different metric. It's formed on the metric of tick, which is independent of time. So each of these charts, the candle is created depending on the tick setting for that particular chart. So this one at the bottom right is on 1597 at the moment. Just move the chat box out of the way if I can. There we go. And just widen that up a little bit. So each of these candles will be created after 1597 ticks have gone through the market. And that is independent of time. That may happen very, very quickly. It could be nanoseconds, milliseconds, microseconds, whatever. Or it could be minutes indeed in the sluggish market. And that's really the core of trading on a non-based, time-based chart, which is that you actually see the momentum of the market. Now, what you also see is through the prism of the tick speedometer. What the tick speedometer does, it actually delivers the optimal setting throughout the trading day for that particular instrument and that particular time frame, because otherwise you really haven't got a clue to what to set that tick chart to. And the first sort of hour of trading today has been really interesting because normally the ES is the most heavily traded index, and normally the tick value can be anywhere between several thousand, can even go as high as 10, 15, 20,000 on occasion for really, really fast moving markets. And what it was doing for the first, while Anna was talking, when I said, oh, the markets are quiet, the first sort of 20, 25, 30 minutes, the tick values were running through at several hundred, and these sort of faster time frames, the 5 minute, I think, was running at about 1,500, 2,000 ticks, way, way off the expectation, what you would normally expect to see for the ES. They all have different characteristics. They all have a different personality, if you will. and the ES is the most heavily traded. Then you've got the NQ and the YM, and each of them will deliver a certain number of ticks. Your range, if you like, your expectation of tick value. So that's delivered through the tick speedometer. But what's also great about the tick speedometer is it then allows you to blend the methodology of volume price analysis with the benefit of trading on a tick chart. And what's fascinating about this session so far is, if I really widen this out as best I can, this was the volume at the open, which under normal circumstances you would expect to see as the highest volume. Generally speaking, it is. I'd say 99 times out of 100 it is, unless there's some huge piece of data that comes in. But then here, if you can see, this volume here was actually higher than the open. So bear in mind, this is a 3-minute candle, and we've got higher volume than's coming at the open. So it's sending you a clear signal that, in addition to seeing the fall away in the selling pressure, which we were seeing here, certainly on these candles, and the amount of buying that was under that candle was tiny, and the amount of selling that was under that candle was insignificant. So the selling pressure is not delivering this price action to the downside. We then see this huge influx of volume coming in under this candle, not necessarily widespread, which is perhaps what we would want to see, but it is indicative of buying coming into the market in strength and delivering. Where have we gone from 25.69? We've gone up to 78. Now we're coming to a little bit of a pause point. We're seeing some weakness come in, decent volume back in. This is expected volume, and on this candle alone, what do we expect to see? Maybe not a full-blown reversal, but certainly some pause point if we're going to continue higher in inverted commas, the longer-term trend on this particular time frame. So it gives you that blend of volume price analysis with the advantages of using a momentum-based chart, which is what tick charts are all about, and Renko charts as well. And in addition to that, what the optimizer also does, it gives you this very simple color coding mechanism whereby what you're looking for are the green regions where you're seeing activity, you're seeing volume come into the market. The orange periods are phases of, let's call them average. That is what you expect to see the market ticking along at under normal circumstances. And where you get these red phases of price action, that's where activity is very, very low. And you expect to see the market in congestion, not going anywhere, because the tick activity isn't there to drive it. So it's a very simple sort of traffic light system, which gives you a heads up instantly as to whether you're seeing well above average tick activity, whether you're seeing average tick activity, or whether you're seeing below tick activity. And that's also reflected over here. It gives you, as I say, this little traffic light system. It's telling you at the moment, we're running a bit sluggish, bit slow, not going to see much happen. So you get this sort of visual picture across the 3 time horizons. Apply that to VPA, and then you drag that over and you apply it to the tick charts as they develop in real time. And of course, all the under indicators work exactly the same way on a tick chart as they do on a time-based chart. Clearly, I haven't got volume on here, because if I had volume, it would just be a row of soldiers pretty much, because they'd all be showing the same volume profile. But all the other indicators are on here. We've got the trend monitor down the bottom. We've got the volume point of control here. We've got the accumulation distribution, which works off price-based support and resistance. And then, of course, we've got this region, which is the histogram off the volume point of control, which is the yellow line here, which gives us an idea of how much volume is sitting up and down the chart. Because as we approach these regions, as indeed we are now at 2580, for example, we've got a relatively low volume node. So the expectation is that if the market can reach this level, it should go through there fairly quickly before we get up to a higher region of volume congestion, which is sitting at 2582, 2583. Now that may not seem like a big move, but bear in mind that when you're an index trader, certainly on the ES, most index traders will look for a handful of points. They're not looking for 10, 15, 20 points. On the YM, the sort of price range that I'm looking for in trading that particular index, you're looking at maybe 30, 40, 50 points, which is $5 a point. So that's $200, $250 a pop, something like that. That's just trading one contract. The ES is a different animal. It's much more volatile, and traders will look for that sort of range of points. So we're in a bit of a pause point at the moment. This is the 5 minute. Let's just pop that up just for comparison. Just widen that out so it's a little bit easier on the eye. There we go. This was the fall away in volume. This was the rise in volume. Nice widespread up candle. Good solid volume below that one. Same volume on this one. So when you look at that as just a straight comparison of one candle and with another and the volume associated between the two, given that this has only moved perhaps 2/3 of this price action, really, by all things being equal, you would expect this to be up here somewhere. It hasn't. It's up here. So, you're expecting perhaps a little bit of weakness, because when you look at those two volume bars, they're pretty much identical. And based on a very simple comparison, you would expect the price candles to be similar, maybe not identical, but certainly similar. That looks a little bit weak. You're then followed by a doji, followed by a little bit of weakness here, potentially coming in. We maybe got a little bit of selling coming in on that candle, and maybe seeing a little bit of a reaction. Nothing to frighten you out of a long position per se. And what it's now about is really trying to identify whether this market is actually going to reverse, or whether it is just pausing into a congestion phase with a continuation higher. And if we go up to this particular time frame, the nice thing about this right now is that from a price perspective, below us, this dash line is a very strong level of potential support. We know that for a fact because it's quite a wide region. The dash line is quite wide. As you look at these up and down the chart, they all vary in thickness. The thicker they are, the more dense that area of price congestion, so price resistance or price support. And in this case, it's pretty wide, so it's acting as a platform of support. It's been tested 2 or 3 times so far. We've got some minor resistance overhead, this very narrow red dash line. And above that, we've got some slightly stronger potential resistance should we get to that region. Trend monitor's bright blue. Let's just see what the ticks are doing at the moment. Don't know why my 1 minute. Let's just change that to 2 minute. Just see if that updates. There we go. Yeah, okay, now we're working on 2 minute. Let's just change it back to 1 minute. Okay, now we're back on. And what you'll also find using this approach is that when we go into red, then the red is almost always associated with congestion. Once we turn red, tick activity is draining away, momentum is falling away, and we're just going to be in a congestion phase. We're in a pause point, maybe a pause point in an upwards trend, but nevertheless it's a pause point. And the tick values will drop accordingly as well. We're down to, that's 1597, that's okay. This one's dropped to 4181. Just change that over. And the reason we have 2 tick values over here is because this is the actual, which changes literally frequently, as you can see there. It's flicking up and down all the time, and the same here and the same here. So what we did was to incorporate Fibonacci, not in any Fibonacci way, but just to deliver the closest value based off the actual, so that in terms of changing charts, it didn't mean you were changing charts literally every 5 seconds on an intraday basis. So what I tend to do is I will set these up on the Fib values when the electronic is running with the cash market, Globex with cash exchange as it is at the moment. And if not, if I'm trading on Globex on its own electronic in the morning, our time, for example, then I'll tend to use the actual because they won't change quite so frequently. And that's the reason they're there. So there's nothing to do with Fibonacci built into it. It's just a mechanism to, let's just pull that back a bit. It's a mechanism to give values which are a little bit steadier when markets are moving fast, which means you don't have to change the charts quite so often. And that's all it's about. Desperately trying to break above this region. Let's pop this one open. See if we've got any more up the chart. No, nothing particular. So we've got a little bit of of resistance here, but nothing particularly spectacular. Trend monitor's blue on that one. We're blue here. We're blue here. So, you know, we're still okay at the moment. That's 1597. That's 4181. This is now, let's just change this over, 6765. And to change the tick, you just put a T on the end and it does it automatically. So it's nice and simple. And we're just in a pause point again, waiting, waiting, waiting. You can see here flip-flopping around between red and orange. Orange down here, and we're orange down on the bottom one as well. Building some regions of platforms of support and resistance. And I've got the Renko running as well. Again, non-time based. I haven't got any other indicators on here. All I've got is the trend dots on here and the pivots. Normally I'd have the trend monitor running on here as well. And what the Renko optimizer does, again, it's a little bit like the tick speedometer. It delivers the optimal setting for that particular market at that particular time of day. Because again, how do you know what to set this to? If you're trading the ES as a scalper, what do you set the brick size to? Is it 1 full point? Is it half a point? Is it 1.5, 2? What is it? What do you choose? It's not guesswork. It does it automatically for you. Just select the time frame. Just select what it is. I've got a minute here. Normally go sort of 1 minute or 2 minute. And it says we're on a 17 brick size. And basically what that 17 refers to, if you put a decimal point in, it's 1.7. So basically it's a full point plus 3/4 of a point. In other words, 7 ticks in total, which is what you'll find the brick sizes are. And the beauty of it is it helps to smooth out the price action, particularly when you're scalping. As I say, the indicators can be applied exactly the same way: accumulation, distribution, the trend monitor. You've got the trend dots here, pivots, everything else works exactly the same way. And it just helps to remove some of that emotional response when markets are in congestion, or you're seeing maybe a bit of volatility coming in. And when the volatility comes in, the Renko will move, as indeed will the tick charts. They'll move in tandem in terms of momentum at any rate. Let's just see if we can break through this 79.80 area. To click that off there. And the nice thing with Ninja 8, which is slightly different to Ninja 7, on Ninja 8 you've got both an interval link and you've also got an instrument link. So you can link things in different combinations. If you want to link instruments together and you want to link time frames together, you can do it. It's all very simple through these little buttons up here. And you've got a whole raft of them there. Just choose a different color for whatever it may be. Just looks like we're pushing through. See if we can get through, see what the volume's like. Excuse me. Okay. Let's pop that up. Okay, seeing the activity come in. Volume's building. See how that price bar closes. It's not too bad. It's okay. We want to clear all this stuff here. We want to get through a nice close, you know, above 80, which we've kind of got. So we've got a nice platform of support in below now. And, you know, that should give us confidence to either hold or maybe jump in if we haven't already. What tick speeds have we got? Yeah, pretty much right. That's this has now increased to 25.84. So we'll just up that one. This one's at 41.81, so we're okay there, and this is 6765, so we're all good to go. So that's fine. Everything's looking cushy, as Del Trotter would have said. Sorry, I'm showing my age. Only fools and horses. Only fools and horses. A bit like trading, isn't it? Yes. Okay. Nothing too scary at the moment. The Renko's climbing nicely. As I said earlier, remember each of these brick sizes is 1.7, so that's a full point and 3/4. That's 7 ticks. So, you know, for index traders on the ES, that's a nice return. You know, 2 or 3 bricks out of the market. Very nice. Thank you very much. But as Anna mentioned, I think at the start of the session, obviously today there is a lot of Fed speak around, so that is going to have a huge impact on the market. And the question that you have to address at this point is how close to these talking heads sessions do I want to get? You know, I'm a scalping trader anyway, so I'm not staying in this for hours by any stretch of the imagination. But nevertheless, you know, it will impact. The closer you get to those meetings, conferences, whatever, then the markets will calm and you'll be in becalmed waters again. So again, it's a balance. We have to factor it in. We have to trade through these periods. It's part and parcel of life, and it's just you know the way you have to learn to trade. Simple as that. You make the decision, nobody else. Let's head over to the time-based charts for a minute. Sorry, pull that up. Let's just go over here, see if they're all doing the same thing. There we go. More conventional charts, perhaps from obviously time-based perspective. I've got basically the 3 indices here now. I've got the YM on the left, I've got the NQ in the middle, and I've got the ES over on the right. And then down at the bottom here, I have the daily time frames, which just give you context, because when you're looking at these moves, these are absolutely minute moves from a daily perspective. You can probably hardly see it. I mean, it's literally a fag paper down here, which is where we are. Yeah, there's been a move to the downside in here, but in terms of price action, you know, it's absolutely tiny. So you just have to bear that in mind, that what you're actually doing right now in trading this market is trading in a very, very tight range. So unless it explodes into life, you really don't want to be hanging around in here too long, unless you see a really big uptick in volume and the markets start to move, you know, relatively quickly and in a more even paced way. But what we're seeing right now is what you would expect to see ahead of some big news releases. Yes, it's ticking up. Yes, there are opportunities to make money to the upside, but it's not moving in handfuls of points right now. But nevertheless, there are opportunities there. The other thing about this also is that when you're trading an index, it's always nice somewhere to have these 3 up together, because you'll get a slightly different perspective on volume and price action. Generally speaking, they do follow one another around relatively closely, but I have to say it's not always the case. Many times you will see the NQ perhaps leading the way. It's been leading the way a lot over the last year, and you'll see that on an intraday basis. You'll maybe see the reaction first in the NQ. You'll see that market start to take off. Maybe the YM, maybe the ES is a bit sluggish, maybe the ES perhaps goes with the NQ, but the YM is a bit more sluggish. If you see that sort of price action going on, and you've got 2 of the primary indices moving, and the other, the Dow, is a little bit more sluggish and perhaps lagging behind, it does present opportunities for getting in based on what you're seeing on the other 2, because the other 2 are big, they're more representative. The Dow is relatively limited in what it represents. So you've always got to bear that in mind. So always have all 3 of them up. They won't always show you that, but they do from time to time move apart. And in that moving apart, you will see opportunities. So just run them together if you're an index trader. What we're also seeing on the daily, which is quite interesting, as far as the trend monitor is concerned, down at the bottom here, you can see now we're starting to see the transition through to bullish. We've had the bearish, we've gone into the transitional colors of the darker red, the darker blue, and now we're coming out the other side into the brighter blue. The sun is shining in equity land again. And the same here on the NQ transition. This is a classic transition, doesn't always do this. Sometimes it might have gone from, let's say, dark red into bright blue straight away, or it might have gone red, then into dark blue, into bright. It doesn't have to go through that sequence particularly. Sometimes it jumps. It jumped here, for example, went red, blue. So it doesn't always have to follow that particular pattern. And finally, I suppose just to make the point on the, as far as the YM is concerned, that hasn't actually transitioned yet. We're still in the darker blue there on the trend monitor, so we've not yet made the transition through to bright blue. In terms of longer term, where are we going? Well, much will depend on the Fed this year and whether they do indeed row back from their rhetoric of last year, which does indeed seem to be the case. But from a purely technical perspective, just on the YM daily, got some relatively minor resistance in here, but this is a strong area to get back up to. The volume here is relatively light, so from that perspective, pretty okay. But once we get back up into these regions here, this is where we've got an absolute ton of volume. The volume point of control is sitting up here with the heaviest volume. We've got an absolute ton of price resistance overhead here, just above 26,000. So there's plenty for the market to get through, and that will only get through there if it's supported with volume. Moving up nicely, let's just head back to the tick charts again to see how that looks. There we go. Let's just get that out of the way. There we are. So, that's all looking relatively rosy picture. Taking some nice points there.
Gosh, it's slow, isn't it?
Yeah, it's not. Anna said it's slow. It's not. It's not roaring up. Compared to what we've had, it's slow, but nevertheless, slow is good. Slow is good. It's not going to frighten anyone to death. Don't think there's any major news other than the talking heads on the.
Actually, see what's happening with this China US.
Anna's just going to check something out with China and US. So that's ticking along very nicely. Let's go back onto the tick charts again. Oops, where are we? There we are. What's it? Oh, sorry, wrong workspace. Apologies. That's the Aussie yen. Oh, actually, it's quite handy. We're on the Aussie yen, and again, it's the market trading is all about risk sentiment. Is risk sentiment strong? Is it risk on? Is it risk off? What is it doing at the moment? Well, from an Aussie yen perspective, which is a proxy for risk, it's just confirming that we're seeing yen selling right now. And hence that's partly the reason that we're seeing equities rally a little bit, which is reflected in the Aussie yen and no doubt probably across the yen complex. Let's just go back to, here we are. There we go. That's the one I meant to go to. But nevertheless, the Aussie yen there, just confirming what's going on. I think the VIX is still trading pretty high though, isn't it? It's still up at, was it at 20? The VIX, Anna says it's got to fall.
If it's going to carry on.
So it's. I have to say it's been up there for a little while. So that is the one to watch. And again, if you're trading indices, you need to have the YM up on an intraday basis because it will tell you what is going on in terms of risk sentiment.
Yeah,
and this is what I said earlier on about the ticks. How many points are you looking to gather on the YM? We've gone from, where are we, 23,770, now we're up to 840. So this is 60-70 points, which is a nice move. That's $200-300, $250-300, something like that. So that's a decent move. Not bad for an afternoon work of an hour or so. That's on one contract. So if you're trading multiples, if you're scaling in, if you're scaling out, then it can be more than that, obviously. But again, just making the point, this is where we are. It's very tiny little bit of price action. But what it also demonstrates is, I suppose in another way, is when you look at days like this, which are fantastic, and this was just ridiculous. I mean, that was the holiday spike, which came out of nowhere and really not supported with volume. But in a conventional day, in a normal day where you have a very solid move like that, it gives you an idea of the potential opportunities available if you get a day when the market is moving. And on other days, you just have to be a bit lighter on your feet and just dance in and out of the market as fits your trading style.
Okay.
I'm going to pass back to Anna at that point. Just changing screens.
Can you hear me?
Okay.
Yeah, okay, fine. It's just there's a little alert just come up. I often go to webinar saying gone a little slow for some reason. Anyway, not to worry, it always we'll crack on. If we have a break, then there's a break, and it normally comes back fairly, very quickly. Just tracking on gold, and as we can see here, not really making much progress either one way or the other, just sort of ticking up and down. What's also interesting is if you look at the time charts, I've got the 3-minute here, I've got the volume point of control, which is this deep yellow line here, where the price has attempted to break away from, but has found support at this line here, which is at about 1292, no, 1290 spot 30, I think that's there. I'll have a look closer on one of the other charts. But what's interesting is, I was saying about congestion, is where you have your 3 time charts, and I hope you have at least 3 time charts when you're looking to take a trade. Don't just rely on one. Is when the price is very close to a volume point of control, particularly on what I call your benchmark chart. So if you're on the 5-minute, this with multiple time frames, you have the chart that you want to take the trade on, but on that you also have to consider what I call a benchmark chart, something that that you frame that price action against. And I have either this, I've got the 30 with gold. On Forex, it tends to be the 1-hour chart, but at least the 30 or the 50. And it's also trading around the volume point of control here on your benchmark chart. This is giving you a very strong signal that first of all, it's moving sideways. It's still oscillating around this the 12, as we've got here, 1291. It's got no direction. It's got no firm direction. A firm direction will, it will happen, and this is where we have to be patient. So if your benchmark chart is giving you this information with an indicator like the VPOC, where we have volume, price, and time, then it will also help to make your trading decisions on the chart that you actually take them to trade on, which is on the faster time frame. And what we can see here, it looks like it is trying to make a breakaway, a breakout trade, a breakaway trade. And I've got the dollar here. I've got it on the index. This is on 5 minutes. This is going up. And generally, as I said, if the dollar is strengthening, commodities. In fact, if the dollar is strengthening, yes, commodities will go down. Is that right, David? Yeah, that's it. So that could explain that. And I've also got the dollar here on my currency strength indicator. This is the red line, so it'll give me an idea of what that's doing there. But what's interesting is the yen's going down with the dollar, and the dollar yen. That's also in congestion as well. So that's what the charts are telling us. I wanted to take this opportunity. I was just catching up on some emails that have come through to me. I don't know if it's someone that's in the room or has written independently, and they wanted to know about the spread. I think they're of the candle and about the wicks to the candle. With volume price analysis, as opposed to volume spread analysis. You sometimes hear these terms used in an interchange, but they're very, very different. And if I can just explain, when we very, very first started, we looked at bars, didn't we, David? We looked at price bars, and you will find that where you see volume spread analysis mentioned, they will use price bars. And my understanding is that the wicks of the candle, when they talk about the spread of the candle, it's the whole the whole price bar from the high to the low. In volume price analysis, where we use candlesticks, the wicks to the candles are hugely significant. They're hugely significant because they give us so much insight into sentiment, buying and selling. And we've got a really nice example here where we have a really nice hammer candle, got a pivot underneath it, a ton of volume underneath it. What is that telling us? The range of the candle from here to here, that's the price range that gold achieved in this 10-minute candle. But if you didn't consider the wick to that candle with the volume, how would you know that is buying? And if there's buying coming in to support the price, what is going to happen? Then the price is likely to move higher. And similarly, with hammer, a shooting star candle, where you have or an upthrust, sometimes it is called, where you have the wick to the top of the candle, that is denoting weakness. And when you have a candle that is a doji candle, where you have it wicks to both the top and the bottom of the candle, that is generally indecision. It can be a reversal, but generally it can be indecision. So I'll write back to that person and say, yes, in VPA, volume price analysis, the wicks are very, very important. It's all laid out in the books. And there's another nice little example here that we see here, this candle over here, we've got where we have buying coming in. What's interesting with gold in terms of the in terms of the volume, you have to see here, this is the 10-minute chart. This would have been in Globex. So that volume, well, that doesn't look very much compared with what's happening over here. The other thing about volume you have to remember is where markets go from they're 24 hours, but they move between financial centers with the different levels of liquidity and different levels of participation. You have to look at volume in a relative way. At the time that was formed, with the volume underneath, that would have been considered to be good volume to help support the price, stop the price falling, stopping volume coming in, buying coming in. It actually made a nice move, David, didn't it? From there, 1293 to 1298. Again, failing, couldn't get through 300, but that's a $5 move. And if you're a scalping trader, that's maybe all you're looking to achieve on the day. And we can see the dollar going up. Let's have a look here. It looks like we are getting a nice breakaway from the congestion period. And just very quickly, I'm just going to look at my levels, see where this is where we're aiming for. When we first started, the gold was in this region, what we call the neutral zone, the buffer zone. It's gone through the S1. It's actually stopped at the S2. As always with levels, what happens with price is they achieve a level, they then generally pause, test that level. Sometimes they reverse from that level, and sometimes if the volume comes in, it will carry on down. Where's the next level? Significant level, well, we've got the S3 just above 1288. And if we look at the 60-minute chart to see if that corresponds with any, we have a confluence of important levels. Let's have a look at the 60. There we are at the moment. We're down to where are we here? R1, yeah, so we could, 1288, which is about the same level there. So that's what I've got to say on that. Anything you want to add to that, Duncan?
No.
And you're good on that? Okay.
Do you have to say the indices are still climbing?
The indices are still climbing, so that's brilliant. Good. Well, as I said, we're waiting for power. Well, climbing, it all comes down to what you are looking to try and get out of the market. at any given time. If you're only going to be, only want to be in for a very short period of time, moves that we're seeing at the moment, that's fine, that's cool, you're going to get something. If you are on the slightly slower time frames, they can be a bit more frustrating. I just wanted to highlight some things that we've mentioned in the session. This is the new front page of the quantum trading site, where you will find details of all the indicators. Those of you who are familiar with the site, it's very different to the one we had before. What we now have is the 3 platforms that we have developed so far for traders. There is a 4th one that we'll be starting on TradeStation. The latest one is TradingView. As you can see here, the indicators that are available on TradingView also run on Mac and Android devices. But what we also have, all the explanation of whether you buy one or whether you buy a bundle or whether you buy the full package. If you do buy the full package of the indicators, there are lots of advantages to that. But the prime one is that when we develop new indicators, they are added to your package for free. So whatever you pay, that's it, you'll get another indicator if we develop a new one. We've got here, you've noticed, we've got a pound indicator for the British pound. Now that's only available on TradingView, but that is going to be developed also for MT45 and from Ninja. And when that is ready to go to roll, if you've got the 4 packages in either of those platforms, that will be free issued to you. So as I said, you don't pay for upgrades and you don't pay for additional indicators if you are on the full package. But many traders just start with 1 indicator, and we've also revamped the internal pages so it makes it easier to, we've collated all the information on the indicators. There's a lot of information, a lot of videos, support pages, and this is where you'll find it. You just click on, you can either search for it or on the front page. Here we have a slider down here, which basically scrolls through every single indicator that we have. And then if you click on it, I've opened it in a different tab. This is actually the volume point of control. You'll see there are videos, support, explanations, how you can use it, how you can benefit from it. Because, as I said in an earlier webinar, volume price analysis and these indicators, they're not they're not our way or the highway. They're there for you to either, if you're a very new trader, to start off your trading journey in this way, hopefully. But if you already use other indicators or you have different approach, different tactics, they're there to leverage those tactics, if you like. And as I said, we've got Elliott wave traders, Fibonacci traders who have perhaps added the VPOC, so that they can look at volume, price and time, to look at the fulcrum of the market. It just makes their tactics, the existing tactics that they have been using, more effective. So that's the VPOC I've got here. I've got the volatility indicator. Again, lots of lovely videos to explain, and these are all shot in real time as well. David has done all the commentary for these, explain how you can use them, what the benefits are for you, as I said, etc., etc. This is the accumulation and distribution, which is only on Ninja. The equivalent on MT45 is just support and resistance. It's slightly different to them. Right, that's that. Is there anything you want to add to that, darling? No, fine. That's it.
Have a nice weekend, everybody.
Pardon?
Have a nice weekend.
Oh yes, as David said, what he'd like is to say is basically have a nice weekend. Oh, there is one other thing. Sorry, I do beg your pardon. With the books, which I forgot, what we've done is now we've bundled them. This is the ebook, so you can. These are all the individual books that are on Amazon. But as you can see here, you've got we've created box sets, but they are just the e-versions, the digital versions. This is the one where it says VPA, but it's also got a book of examples for, it's got stocks in, but it's also got indices, and this all time frames are covered from the fastest time frame right through to the daily, weekly, and even the monthly. And that's all that remains for me to say, other than to thank you so much for coming along. I hope you've enjoyed what we've covered. But if you do want any more information, clarification, you can either drop me a line, anna@annacooling.com, or david@quantumtrading.com. We are back on Tuesday for Forex, David. London Forex, that's when we're back. So if you're coming along to that, fantastic. We'll catch you then. Otherwise, we are back at the same time next week. Take care, everyone, and enjoy the rest of the trading week.